moving on and maybe moving to equity markets a bit more broadly, they appear to be remarkably complacent despite the ongoing uncertainty driven by the conflict in Iran not having been solved. We talked about AI, but and you look at the US market, it's made an all-time high. I would suggest that a lot of that is being driven by AI related companies.
Yeah.
But more broadly, do you think that there's going to be a shift? Do you think that markets are a little bit complacent given it almost feels like the energy crisis and energy is something we perhaps don't have time to get into it today, but we've discussed it before. You need an enormous amount of energy to build AI because of the data centers and that all has to be powered, et cetera, et cetera. So do you think that the equity markets, notwithstanding all the capex expenditure in AI, is becoming a little bit complacent? And do you think that the energy market is perhaps reaching a cliff over which we might just run out of? I mean, I'm kind of surprised that fuel prices in Australia aren't a lot higher than where they are now, given the scant reserves that we had. So, I mean, what are your thoughts? Do you think equity markets broadly are just a little bit too complacent, or do you think they're sort of where they should be?
I think I, I think Australia faces some very difficult months. We're getting hit by pretty much everything. Very, a big pickup in inflation, a reserve bank that's raised rates 3 times. We're very vulnerable to the energy crisis, and we saw that initial sharp rise in diesel and petrol prices here. And now it's come off a little bit, but I'm afraid if we go to the end of June and the Strait of Hormuz is not opened, you're going to see our diesel and petrol prices go back to the levels we saw in March and even higher.
Mm.
We've been very lucky or the world has been very lucky, as I said right at the outset. China has decreased its imports of oil, i.e., it's not making purchases as much purchases in the open oil market, and they've tapped into their huge reserves. And we've been the beneficiary, as indeed the whole world has. And then the United States has also tapped into their reserves and are selling oil. Their increase in their oil exports and also refined product exports has been very significant. But that's because they're tapping into all these inventories. We are now losing an extraordinary number of barrels. So since the war, we've lost over 1 billion barrels of oil because of
Mm.
the closure of the Strait of Hormuz. And it just so happens we have this kind of illusion at the moment that everything is fine because, of course, they've just gone in and tapped into the inventories that were there before the war started. But as time goes by definition, those inventories are running down. Now, so that basically leads me to say this, that, again, 19th of May today, in the next 4 to 6 weeks, I wouldn't be surprised to see oil trade at $150.
Well,
Now, the oil people, it's a really tough conversation to have, any conversation about oil. And it's since this war started that I realized that, the oil world is just a different world. And the oil analysts that I've spoken to are, wow. When they
yeah.
give you the arithmetic, it's pretty scary. So the oil analysts and the oil market would agree with you that we're all being a bit complacent. So basically, I would not rule out $150 on oil by the end of June. And if we get there, what does that do? It just
Mm.
accelerates the increase in inflation. Because the simple, undeniable fact is that every single thing that I can touch and feel in the room around me right now, every single tangible thing I can touch has arrived on a truck at this property. And diesel is the lifeblood of every economy. And Australia has the highest consumption of diesel per capita in the world.
Mm.
We're the most dependent on diesel of any country in the world. Now, that means that we import the 80 to 90% of it. So as time goes by and inventories run down, you're going to have countries around the world that are going to try and ring fence and protect their own diesel.
Mm.
And I'm afraid we're heading to that point. We're heading to that point. What does that mean? It means inflation rises. So we're now seeing producer prices around the globe really beginning to ratchet up because of higher energy prices, whether it's gasoline, whether it's diesel, whether it's jet fuel. And as a consequence of significantly higher inflation, central banks are now have abandoned any prospect of cutting rates.
Mm.
But as you highlighted earlier, this massive, massive surge in earnings, driven almost exclusively by AI, has masked the kind
Yeah.
of inflation energy shock. So what we've all done is we've kind of gone, wow, AI, AI, AI. We only had eyes for earnings and AI. And we've kind of allowed this energy crisis to kind of hum along in the background and not pay a lot of attention to it. But I'm afraid as the next 4 to 6 weeks, I think the market will start thinking more about the rise that we've seen in bond yields. And I've been alerting my subscribers to this in the last couple of weeks. This very sharp rise in bond yields
Mm.
um, is significant.
And you think this is more of an Australian problem than a US problem, Jonathan?
I think I think we're acutely vulnerable because we
Yeah.
have chronic energy insecurity. Because of course we've had successive governments, and I'm not picking on any one particular government. I mean, decades of incompetence have consequences. And every Australian government, both Liberal and Labor, in the last 20 years allowed us to get to a situation where we only had 30 days of energy in reserves. And it's the lowest in the developed world by a very long way, in fact. So we're very vulnerable, and I'm afraid that we're seeing the push through inflation, and so we've got some difficult months ahead here in Australia. Now, in the United States, we saw the latest producer price numbers. PPI rose at an annual rate of 6% in the month of April. And that's a real sharp rise from levels we saw in 23 and, 24 and 25. And even in China, for the first time, don't quote me, but I think it's something like 46 months, we saw a positive PPI number. And in fact, we saw a sharp acceleration in producer prices in China and in Japan. And so I'm afraid these higher energy prices, and because the duration of the closure of the Strait of Hormuz is now pushing inflation up, and that has also fed into higher bond yields, Eugene. And we've been quite negative lifespan on long-term bond yields, but they've really gone up in the last couple of weeks.
Yes, indeed. Um, we've talked a little bit about the impact on Australia. Well, let's talk just briefly about the RBA and inflation in Australia. So the RBA has come out and said they expect headline inflation to peak at about 4.8% in mid 2026, with underlying inflation remaining below 3% until mid 2027, driven sharply by higher fuel and raw material costs from the Middle East conflict. They raised the cash rate to 4.35% in May. It's third hike this year, as you said earlier, and markets are pricing a further rise to 4.7%. So markets are sort of pricing definitely another one rise, and possibly maybe a 50-50 chance of a second by the end of the calendar year. Um, so what do you think about all of this? Do you think that that's likely what's going to play out? And I mean, it doesn't look as though other countries are talking about aggressively raising rates in the same way that Australia has. They've kind of pivoted from expecting rate cuts, and actually late last year we were probably expecting rate cuts in Australia for 2026, but other countries are sort of now preparing everybody for no rate cuts. Maybe they'll have to raise rates, maybe they won't. But this probably puts Australia at an even further disadvantage. And yeah, I've taken note of what you've been saying about our fuel reserves being, incredibly low relative to the rest of the world, and certainly the rest of the developed world. So yeah, I mean that kind of adds, excuse the pun, but fuel to the notion that Australia is probably going to struggle more than other countries.
Yeah, I think so. It's yeah, I think I'm afraid I agree with that assessment. I think Australia is going to struggle. As you say, we've had three consecutive rate hikes. I think Michelle Bullock will probably have to do another one, and there'll be the possibility of a fifth one. But the bottom line is, um, yeah, it's the economy is slowing here. I mean, anecdotally, I'm speaking to a number of people just in the last couple of weeks, and people on the front line of, in the property market, developers and people like that are saying, wow. Things are
Yeah.
slowing here. And then, of course, the Australian budget probably didn't help either. So, yeah, you've got an unfortunate mix of circumstance here. And there's some speculation that we're kind of moving into a messy stagflationary
Yeah.
environment of higher inflation and very, very anemic growth. So, yeah, I'm sorry to say that I probably agree with that. And then, as you were saying, the the Europeans are going to raise rates next month. The
Right.
Bank of Japan is going to raise rates next month. The Fed, remember, Eugene, at the beginning of the 2026, the market was pricing with certainty that the US central bank would cut the US federal funds rate 2 times in 2026. And there was even the possibility of a third rate cut priced in 2026. Well, those have all been abandoned. And and
Yeah.
and, and let's just acknowledge that Kevin Warsh is now the new Fed chair. And I don't think Kevin Warsh, when he basically expressed his desire for the job, could possibly have imagined that as soon as he becomes the Fed chair, he is going to enter a meeting with his colleagues on the FOMC where there may be actually a call for a rate hike
Yeah.
by the US Central Bank. Now, just imagine if Kevin Warsh raises rates, what will Donald Trump do? Well, we know what he'll do. Um,
He'll
yeah,
throw a
so
hissy
the
fit.
the money, hey,
I said he'll throw a hissy fit.
he will, he'll take to Truth Social, and it'll be
Absolutely.
an entertaining read. So the central bank and monetary policy landscape has done a complete U-turn in 2026 as a consequence of higher inflation. And the
Yeah.
one thing the central banks don't want is for inflationary expectations to get away from them.
Yeah.
And so as a result of that, you're seeing long-term bond yields rising sharply, yield curve steepening around the world. I mean, the long end in the UK, we haven't spoken about the UK. I mean, the UK is a disaster. And
Mm.
I've been writing about that for some time in my report. It gives me no pleasure whatsoever because I've got quite a few British subscribers who asked me to take it easy. But I mean, the writing was on the wall that Britain is in trouble. We've got political turmoil, we've got a declining British pound, and rising UK government gilt yields. So yeah, I mean that's the kind of the world around us is one where there's more tension now between bond markets and equity markets. And last Friday, the price action on Wall Street on last Friday was a bit of a wake up call for me. And I said that in my report on the weekend that maybe we've just crossed over into that new terrain where the rise in bond yields is getting the attention of equity markets now. And I think as a
Yeah.
result of that, these next few months are going to be could be very turbulent. And one more thing, sorry, Eugene, one more thing. Every Fed chair, and I've watched a lot in that job from 1984. Every single Fed chair that I've seen since 1984 has been tested by Wall Street early on in their tenure. And I think Kevin Walsh is going to be tested by Wall Street. Now, I can't explain to you why Wall Street always tests a new Fed chair. Maybe it's just a game they play, but I've seen it. I remember them all. And I think Kevin Walsh is going to be tested in his first few months in office.
When you say tested, you mean Wall Street sells off and
Yeah.
sees whether or not the so-called Fed put is still alive and well, still in play. Yeah, okay.
Yes. And I think the bond market will basically knock on Kevin Walsh's door at the Eccles building where the Fed resides and remind the US central bank who's the real boss, because the
Hmm.
bond markets are the ultimate boss.